Welcome back, everyone. This week, we're going to try to do a quicker video, sum things up, go over some interesting screenshots I took of varying topics that are somewhat related to finance, and then we'll wrap up with my portfolio's end-of-year performance, how I did, so stay tuned. So, as you see, these are rough numbers. NASDAQ is up roughly 55%, S&P 25%. I just found this meme funny because here you have TLT sitting at 3% and cash is at 5%. Now, of course, TLT's the 20-year, and it doesn't necessarily reflect the entire curve perfectly or this or that, but it's kind of funny how that works. And a lot of people this year talked about how it'd be good to sit in treasuries. Why not collect a 5% yield? And that's kind of a ridiculous statement to me. And I felt that way the entire year. That was before the market went up either 25 or 55%, depending on how you want to measure things, or 18% counting the Russell 2000. This whole idea of why not 5%? Because the market very well could go up 25% this year and then down 25% next year and cancel everything out. And then the people who said, why not sit in 5%, sat in 5% for 2 years and they're up 10% while you're flat. And that can most definitely happen. And that's worth considering and factoring into how you manage your cash. But the whole point of why you wouldn't sit in 5% is the consequence of because you're trying to accrue wealth on an absolute level, which means that you have certain goals and targets that you need to hit, and 5% is just not going to cut it. If you believe the CPI number, so let's just call that 3%, so you have a 2% spread, so you're making 2% real money. You're not going to really get anywhere in life making 2% a year. Now, yet again, you can always make a argument of relative privation, which is worth Googling, in which one person accrues 2% a year over 50 years, while another person loses all their money because the stock market goes to zero. And then, but we're doing things on a balance of probabilities and trying to conduct ourselves in a fashion that's conducive with our goals, understanding that spectrum of possibilities and outcomes. And honestly, just simply put, 2% is not going to get you there in all likelihood. Because if you're watching this channel, or if you're the vast majority of Americans, 2% is not enough. So that's why I think it's an absurd statement. But to each their own, and everybody needs their own investing strategy that's curtailed to them. So the whole 5% has just been a non-starter to me since time immemorial, essentially. My time immemorial, even though that's a subjective way of speaking of an objective term. This is funny. I really like this account. He does a lot of good meme posting and shit posting. I appreciate that. It's very comical and enlightening, and kind of takes a contrarian's point, and not the run-of-the-mill, middle-of-the-road contrarian that's kind of a majority of a minority, which is how most contrarians are. What do I mean by that? Let me give you an example. People investing in uranium are talking about being a contrarian. You were a contrarian in 2018, 19, 20. So what will happen? Tin. Take tin, for example. TIN. That's not getting much love in the investing community of the hard assets value investors. But if, for instance, or Sibanye-Stillwater, platinum, palladium, rhodium, tin, to keep my original example. Once those things are up 50% or 100% off their lows, if that does happen, then everybody will start talking about it and piling in and talking about being a contrarian. It's like, well, maybe now's the time to actually be a contrarian on tin or lithium. That thing's down hard. Pretty much any, or yeah, I mean, there's multiple commodities that have fallen quite hard in the last couple of years, and then buying them now. If you bought ticker symbol CHIR, which is quite a small fund at this point and runs the risk of being closed down, but if you bought that Chinese real estate, you'd be a contrarian. If you bought banks, like I bought KRE in March or April, you were a contrarian. Not when it's getting much love. Buying banks now would not make you a contrarian. Anyway, with that, the reason I bring that up is because he actually posted something a couple of weeks ago about the RSI and how the RSI, I think, was at 86 and it was therefore in the overbought category of things. And then, so a lot of people have been posting and talking about how the market's overbought and therefore you shouldn't buy and that you might even consider shorting. And then so he posts throughout history times in which the RSI was at 86 and then it had still quite a good bull run for at least the subsequent year or more. And that's contrarian right there. That's the kind of contrarian you're not going to see. But or very unlikely to see much of. So he posts, "We like the thing that just went up 25% over the last 6 weeks. Strategist." And that's how it goes. There's these memes that's been going around that we are upping our S&P target to 5,100. Now I don't believe this is technically true of Goldman Sachs, but it gets to the gist figuratively and not literally as to how these people play this game. We're upping our target. What was your original target? 4,700. Be honest. 3,600. Thank you. And that brings us into quite a interesting dynamic of people foolish enough to listen to these sorts of analysts. This is where banks predicted where S&P 500 will end the year at the start of the year. So at the beginning of 2023, these are varying banks and where they predicted the market would end. So here we are. And you could say that they were all off by some extent. And it's interesting because what you notice each and every year is that they give you about a 5 or 10% range. If the zeitgeist of the market is skewed one way or the other, they'll give you a higher target or a lower target. As well as people like to be optimists and they're here to sell things like stocks, and you're only going to make money on stocks if they go up. So they'll tell you why there's green shoots emerging and why things look positive into the future, even though in the short term it doesn't, but in the multi-quarter period it does. And then they'll give you a 5 or 10% range. Oil analysts do this. Practically the large, vast majority of people, analysts, and companies do this. So you might ask, why? And the answer is why wouldn't they? What is their incentive structure? Like they don't want to, it's the whole idea of it's better to be wrong with the herd than be right by yourself. Because oftentimes being right by yourself causes you to be wrong in the short term and be ridiculed, criticized, and actually lose your job. Because that's how people view things. And everybody wants to talk about long-term time horizon performance and this and that. But the fact of the matter is that's just that, talk. Most people do not act that way. So we can see estimates on where the S&P will be at the end of 2024 in 1 year's time. And guess what? It's this 5 to 10% range. It's all this conservative, middle-of-the-road approach. Now, this can radically expand into the conversation and discussion of why do most hedge funds underperform the S&P 500? And one of the reasons is because they're incentivized to do so. And they're incentivized to do so by the subconstituents of their funds, i.e., the individual investors. And that's an entire article, an entire publication in and of itself. But remember that, because it's easy to say, oh, these people are stupid, they never get it right. Who's to say that their job is to get it right? It's the wrong framing of it. It's viewing something based upon one variable in isolation to get it right, as though there's not other contributing factors to take into consideration as to why they might give the forecasts they give, as I just discussed. So you'll see that their 2024 forecasts are roughly this 5 to 10% range. And I'll just go ahead, I'll make a forecast. I'll say that their 2025 forecast will be within a 5 to 10% range of where the market closes at the end of 2024. So an interesting discrepancy I want to point out, because I try to do that in a transparent fashion, because I find these things frustrating, and I suspect that a lot of people newer to the market might not be aware of these discrepancies, as well as confused by them. And sometimes I know the reason, and sometimes I don't. I don't know the reason in this instance. But this says, you go to Google, very simple, type in SPY, performance, year to date, here you go. It says up 24.81%. But then if you go to another place, Koifin is often where I go, but you might go somewhere else, TradingView, FinViz, stock charts, I don't know, other places. This says that the SPY is up 24.29. So 0.29 and 0.81. So that's about a 0.5% difference, which you could say doesn't matter. And you could argue if you had millions upon millions, then 0.5% matters and equals tens of thousands, if not millions. And very true. But just imagine a fund managing $1 billion and they get paid on the performance spread, okay? So why would they not? And I don't know how they go about this, to be honest with you. I suspect they use whatever Bloomberg says. That seems like a standardized, acceptable practice. So I'm not quite sure. I should have, speaking out loud, I now thought of that, so I should have looked that up. But that 0.5 point performance difference can make the difference of millions of dollars to that fund. You know, if the fund performed 30% and one site they go to says the market was up 24.5%, then that's 0.5% of millions that they can pocket, as opposed to if it was up, say, said 25%. And then another interesting juxtaposition occurs. So here you have the SPY. I'm going to say it's up 24.29%. But that's not the total returns. Because, as you might know, or might not know, the S&P 500 pays dividends. So the total return is actually 26.18%. So which is the benchmark? Now, if you're being intellectually honest, as far as I can tell, there's only one benchmark, and that's the total return. Why would you not make it the total return? And by the way, what I plan on doing starting next year, because quite frankly, I don't want to, and I'm lazy, and yeah, mommy, those are the honest reasons. What I should have done this year in my portfolio performance comparison is do a dollar cost averaging, or at least record what it would look like if I invested in the S&P, because I'm saying my benchmark is up 26.18%. But what would the performance of the portfolio have been, which had $50 contributed to it each week throughout the year? What would be the time-weighted average rate of return? Because as opposed to the cumulative return from the start of the year, because that presupposes that all the money was invested up front, which when you're depositing consistent cash flows on a weekly basis, it's anything but front-end loaded. So it's not an intellectually honest comparison. So what you really should do is do a time-weighted average rate of return of the total return of the S&P 500 over the year. Now that's going to be challenging, so I'll probably do a time-weighted average rate of return of just the weekly performance, and then, I don't know, throw in, I'm not quite sure how I'm going to control for the dividend, or if I will. But at some point it'll matter. I might be up 27% on the year, and then the market's up 26% on the time-weighted average rate of return, and then I say, did I really beat the market because I'm not factoring in the dividend? But how do I factor in the dividend into? Do I just try to assume what the dividend's going to be and then divide it by 52 and incorporate that, whatever that decimal figure is going to be for each way? I just don't know. And then you just say, well, you don't know. And so the total return. Now, I don't see a lot of total return statements out there. I see the stock performance return, the capital gains, which would be 24.29%, but total returns are 26.18%. That's a almost 2% difference. And 2% differences matter as far as I'm concerned. So on to some random screenshots I thought I'd share with you. The current U.S. inflationary cycle is eerily mirroring the 1960s to 1980s, implying that potential could reawaken with a vengeful after the election. This could be a serious blow to consumer confidence and faith in policy. So this is just a picture. The current inflation cycle is mirroring trends of the 60s to the 80s. I'm sure if you've been around investing at all, you see these charts that overlay on top of other charts to try to suggest something. What statistics are like bikinis. What they suggest something, but what they conceal is crucial. And then what's the differences between the time periods and this and that. So with that said, if you believe in this overlay, then you only have till no longer than till 2025, so 1 year until inflation starts ripping again. So if you believe in that, then you should be positioning. That's the whole Annie Duke you want to bet. We'll see who actually believes this by how they position. So, and what you'll find out is a lot of people who said they didn't believe because their behavior doesn't reflect the belief. And then you might say, well, who really cares what they believe if they don't act upon it? Which is a whole conversation in itself. This is an interesting one, and I'm not going to read it all, but you can freeze the video and just read it yourself, or that's why I provide the name and the date, so you can go look it up for yourself if you want to see more about it or see what other people in comment sections had to contribute to the conversation. But it's kind of interesting. You don't hear about these things in history class in school about what's one of the things that led to Rome's collapse. And then no one talks about the devaluation of the currency. 27 BC, Augustus worked to establish a standardized system of coinage for the empire. The silver denarius became the currency that was accepted as payment in commerce and taxation. Augustus set the weight of the denarius at 84 coins to the pound and around 98% silver. And then you go down. Let's just go with 198 to 217 AD. So about 200 years. 200 years, Emperor Caracalla lowered the denarius to nearly 50% silver to pay for the Roman war machine and his grand building projects. Around 200 AD, soldiers began to demand payment in gold or other commodities. So right there, in 200 years, they devalued the currency by 50%. And then it just gets worse and worse. And it's just interesting. If past is prologue and if history often rhymes but not necessarily repeats, then it might be worthwhile to wisen up to how things have played out historically. Not in a fear-mongering sense, but perhaps, but so that way you can have a more integrated and comprehensive understanding of how the world works, so that way you can better work in the world. This one, we're getting close to the end. I only have a few of these. This one kind of just irked me. This individual said, I'm not sure I've ever seen a finer financial tautology. So a tautology is saying the same thing in different words, which is a common feature in life and with people. And as such, since the finance industry is predominantly involving people with lives, then it would only make sense that it would creep into that microcosm as well. And so it does. And someone's trying to pump a stock and talk about how they're going to do well. And they'll say that they're doing that. We're going to reduce debt. We're going to increase assets. And we're going to improve the balance sheet. It's like, okay, I mean, that's nice. And some people might consider that a tautology. But the example here is, we said we would get Naked back on track to profitable growth by doing 3 things. Number 1, strengthen the balance sheet. Number 2, making the profit sustainable. And number 3, getting us back to profitable growth. What I believe this individual is noting as a financial tautology is that making the profit sustainable and getting back to profitable growth is the same thing worded differently. And the problem with that is it's not a tautology. Those are not the same thing. And they're distinctions with quite a difference. So I've most recently, as a slow adopter of things, which makes me a horrible thematic inflection investor, which one might consider me being to some extent, which is an interesting juxtaposition in and of itself and makes things tough. But as a slow adopter of ideas, technology, and practically most things in life, I've just now very recently started utilizing ChatGPT. And I'm not going to get into its strengths and weaknesses, but as far as I'm concerned, it's better than talking to the vast majority of people for numerous reasons. I might make an entire publication on why I like ChatGPT and cautions around it. But I asked ChatGPT to validate or invalidate my belief that that was not a tautology. And by the way, the reason I blocked his name out is because I actually like the individual, but I want to spiral in an existential way, which I like doing, or is natural to me, and sometimes is horribly counterproductive. But either way, it has its benefits and it has its costs. And it'd be interesting, like, say this person, I gave this person money to run for me. I would be extremely alarmed into thinking, in knowing that they think that sustainable profits are the same as profitable growth. So that means that they think that if a company has sustainable profits, that they also have growth in those profits. But that's not necessarily true. You can keep your margins the same, maintain the same profit. Yet again, you have to ask how you're defining profit. In this case, I'm saying margins, but it could be net income. You can maintain the same net income, okay, and they think that's the same as net income growth? Because that's what they're saying. If it's the same thing, said it different, then they think profit growth or profitable growth. You can have profitable growth. So profit sustainability, how do you measure that? Now, look, the piece goes on to explain things, but you can have sustainable profits, whether that's consistent 10% profit margin or $1 million of net income each and every year. That would be well enough considered sustainable profit. But profitable growth could mean that your net income goes from 1 million to 1,100,000 to 1,200,000 to 1,300,000 and so on. But the entire time that you're growing the net income profit and it's growing, the margins are shrinking and shrinking and shrinking. So to conflate sustainable profit with profitable growth and to think that they're the same thing is alarming to me. But this is one of those, well, I'm not going to say this because this would be a sign intent, but a statement like this is a cautionary yellow flag, let's call it, to the sort of character of the individual saying it. Because frequently enough, but not often, which is why I'm not assigning any intention here, because I would actually argue that this is not what they're doing, is they're like, it goes along the lines of, look how smart I am, let me use a big word to identify something to appear more intelligent by the contrast of me pointing out what they're doing. And then you have to ask, why would someone want to communicate that way? And what kind of deficiencies and ineptness and inadequacies are of that person's character to behave in that fashion? What kind of person are they? And if you're giving them money, or if you are following them for insights and information, if you don't think that that reflection of character is going to also bias the insights and information or how they manage money for you, then you're horribly mistaken. So, onto a tautology. I asked chat, as I affectionately call it, are the following two phrases a tautology? Making the profit sustainable and getting back to profitable growth. This is what ChatGPT had to say. No, the phrases making the profit sustainable and getting back to profitable growth are not examples of tautology. A tautology is a statement that is true by virtue of its logical form, regardless of the specific content or meaning of the statement. It is a redundancy where the statement repeats itself or restates the same idea in different words. In the given phrase, although they both involve the concept of profit, they convey distinct ideas, which is important because what a lot of people do, whether consciously or not, I don't care about the results. One of the few times I'm result oriented, even though I do actually care about the intentions behind it and motives, but I'm starting to learn to deal with people based upon their behavior because I just have to for psychological reasons and such. But people will broaden out a category to be right. So in this case, as chat noted, although they both involve the concept of profit. So therefore, if you talk about profit in more than one way, then under a broader generalization of the category of profit, then it's a tautology. But the more you define things, the more you make it specific, the less of a tautology it becomes. So just remember that with practically all things people speak to. So, in the given phrases, although they both involve the concept of profit, they convey distinct ideas. Making the profit sustainable implies the intention to ensure that the profit achieved can be maintained or continue over time. It suggests a focus or implementing strategies or practices that contribute to the long-term viability of generating profit. Getting back to profitable growth implies a situation where profitability had previously declined or stagnated, and the goal is to revive or improve profitability by generating growth. It suggests a focus on taking action to increase revenue, expand market share, or improve financial performance. While both phrases relate to profit, they express different intentions and objectives. They are not redundant or tautological because they convey distinct ideas within the context of achieving and sustaining profitability. So there you have it. And I believe this is the last screen grab I took, so bear with me. Popper's view on the science is settled. And this is quite applicable to financial investing and really conducting yourself in life. The popular notion that the sciences are bodies of established fact is entirely mistaken. Nothing in science is permanently established, nothing unalterable, and indeed science is quite clearly changing all the time, and not through the accretion of new certainties. If we are rational, we shall always base our decisions and expectations on the, quote, the best of our knowledge, end quote, as the popular phrase so rightly has it, and provisionally assume the truth of that knowledge for practical purposes, because it is the least insecure foundation available, but we shall never lose sight of the fact that at any time experience may show it to be wrong and require us to revise it. So how does that apply to investing? Because that's what this channel is about predominantly. Well, that's a fancy way of speaking to the sentiment of the idea that as the facts change, you need to change your view on the facts, which has been put all different ways and expanded upon and expounded upon and pontificated about and blah, blah, blah. So just remember that. You could be bullish something all of 2023, and then this last quarter, new information's come out that shows that maybe the theme isn't trending like how you thought it was going to. Not the stock price, people, okay? Not the stock price, but the actual fundamentals and themes of the actual trend and the theme. Not what the stock is doing, people, okay? So, you might have been bullish something Q1, Q2, Q3, Q4 comes around, information's not looking that good. So then you're going to have to start reevaluating matters. Is what it is. So, let's not forget that. So, on to my portfolio performance. I closed the year out up 32.29%, and the S&P, as you note, is up 26.18%. That is the total return. You know, it's so stupid to not compare yourself to the total return unless you did not accrue any money from dividends. Because in my year-to-date performance of 32.3%, as I'm going to call it, and 26.2%, we're going to round, I know, I got money from dividends, okay? And then that money went into my portfolio, and then that was reflected in my performance. So I factored in the dividends that contributed to my portfolio and then represented that in the performance of my portfolio through these percentage changes that you see month by month. So would it be fair? Would it be intellectually honest? Would I be a person of integrity to then not consider the dividends contribution to the S&P 500? Talk about disingenuous. Talk about cherry picking. Talk about not keeping constant your comparisons and controlling for variables. It's absurd. So although I don't like the additional 2% bump that the dividends gave to the S&P, because it'd make me feel a lot better for whatever the reason if the S&P was at 34%. Why? Because then I would be, I'm sorry, if the S&P was up, was at 24%. Why? Quite simple. Left digit bias. Because I would do something like 32% versus 24% is 8%, and 8% is pretty close to 10%. So I beat the S&P by almost 10%. That's the kind of narratives we tell ourselves. That kind of sloppy ass mental accounting. So that's why. And I recognize that. The difference between me and a lot of people is I'm cognizant of it. So that's what would happen. I beat the S&P by almost 10%. That's why I would tell myself that. I kid you not. And a lot of people would tell themselves that too. Now I know better, but so nonetheless, so I guess you could say I beat the S&P by 6%, which is fine, but 6% isn't 8%, which ultimately becomes 10%. But nonetheless, I also wanted to note that, as I've detailed before a few times, I normally have one good month in a quarter and then 2 down months. That happened for Q1, that happened for Q2, that happened for Q3, and then Q4, you might have noticed I was somewhat nervous going into the last month because I knew I had a 5% spread on, actually less than a 5% spread, because that spread was innocently me comparing it to the capital gain performance of the S&P without factoring in the dividends. So I had, we'll just call it though, a 5% spread to the S&P. And that's not enough. That's not enough lead to be confident for a whole month, because numerous scenarios could play out. For instance, my portfolio could fall 2.5% and the S&P could go up 2.5%, and then I would lose. Or I could fall 3% and it could go up 2.5%. I could, there's all kinds of mix and matches. Or the S&P could go up 10% and I could go up 3%. So I was nervous. Really, my hopes, I killed my hopes going into the month, or at the start of the month, because the start of the month's performance, I think the first week was not that good. There was a week, no, it wasn't. I think there was a week where I lost like 3.5% or something like that. And then, like, ouch. And that, the S&P fell that week too, but not 3.5%. So that narrowed the spread a lot more. And I was not too optimistic. I figured there'd be tax loss harvesting on my names and so on and so forth. And it was not looking promising. And that shows you what a couple weeks make. Because in 1 month, I thought December was going to be a month where I lose 5%. That's what I thought was going to happen, or more. And then this whole 1 good month, 2 bad months was going to be 3 bad months, even though I made 3.5% in November. But sure enough, I actually ended up December up 6.22%, which is funny. Let's go back to the big banks S&P predictions. Now, you might argue that why 5 or 10%? Because that's within the historical range of what the S&P does. So here I was in 1 month's time thinking I was going to be down 5%, and instead I was up 10%, which means I got it wrong by 10%. You understand? My prediction, I was afraid I was going to close down 7 to 10%. In all actuality, I was afraid. That's not to say that I thought it was going to happen, but that's what my emotions were preparing me for, and to beat the S&P practically all year long, to have it taken away from me in the last month. That's what I was preparing. And so I'm thinking negative 7 to 10%. So then I end up 6%, which is to say I got the spread wrong by 13% to 16%. Like, talk about being wrong. But it's just funny, this whole prediction thing. So we'll go to the next slide, which will be my names, I believe. So I closed the year up 32.3%, which beat the S&P total returns by roughly 6%. So I'm happy with that. And here we go. These are the names. This is where we ended. I ended the year. You might note that I have a 33% position cap for any particular theme, and right now my offshore oil names are making up roughly 29 to 30% of my portfolio. Am I going to add? I don't know. I wanted to end the year, as those who are more dedicated to watching my channel know, I've been trying to stack cash since, I don't know, mid-November, something like that. And then I failed for a couple of weeks. And then I did pretty well. My trading, just to keep me entertained, busy, take advantage of asymmetrical risk rewards, however I want to justify it to myself. My piddling around radically reduced in November and December, and I would even say October. And the summer months and early fall were busy piddling around day or months, and don't know why. That's worth a post-action review in and of itself, but nonetheless, I've been trying to stack cash. I'm at 10%. As the account grows, it will take longer for me to stack cash than beforehand. So if I wanted to get the 50% cash in my account, all else being equal, I would have to not make any stock investments throughout the entirety of 2024 in order to get to a 50% cash position. I'm not saying I'm going to do that. I've noted before that anytime I get more than 20 to 25% cash, I will, in all probability, underperform the market. I don't know what I expect out of 2024. So I actually I don't care as much. This is psychological, mental accounting, compartmentalization, but there's truth to it. I don't really care too much if I underperform the market January, February. Why? Because I have another 10 months to make it up. So I'm more likely to stack cash at the beginning of the year. Not that I'm trying to chase performance, it's that I'm fine being more cautious and waiting things to set up for me at the beginning of the year because there's more time to play out and there's more chances of something correcting. So there you have it. It's kind of funny if you think, I made fun of TLT earlier and the people advocating to own treasuries to collect a 5% yield or sitting in cash in a money market fund for 5%. So let's just call it 5%. Had I invested, had I just, if you look at my portfolio, let's see, Leonardo DRS, Valeris, Triple Flag, Transocean, and Franco Nevada. What does that make up? 2%? Wow. 2 plus 10, so 15, 23, 27. We're going to call it 28% of my portfolio has underperformed cash. And that's just how it kind of goes. At least that's how it goes for me. Other names radically outperform cash. Kinross, 42%. URNM, 38%. Tidewater, 35%. Sprout Physical, 35%. Louisiana Pacific, 24.5%. You get the point. So they radically outperform cash. And that's kind of how it goes. You know, Munger and Buffett talk about this, which you never make an appeal to them, especially if you're underperforming the market. That's just no one wants to be that guy. But they said, and I believe this, and since people are so easily persuaded by appeal to authority, why not include their name? But I really do like Munger, actually, and, RIP. And they said, if you take away our best 10 performing companies we've invested in, our performance would be horrible. And fair enough. That's the Pareto distribution, which is an entire publication in and of itself and how things play out that way. And that's also a significance of letting your winners run and why some people talk about cutting your losers or early and so on and so forth. So it's just an interesting perspective to say that 28% of my portfolio underperformed cash, which in some ways means that it's all about how you want to justify things. I'm not interested in doing anything. For instance, you could say, wow, good job, you beat the S&P, or wow, good job, any year where you get 33% returns is a good year. But you could also say, man, for the risk you took, playing the names you're playing, you kind of need more than a 6% outperformance, in which I agree. But I would also agree with the statement, wow, you did 33% in a year and beat the S&P 100 even though 28% of your portfolio underperformed cash? Great job. That's also a true statement. And the thing is you can justify these things all you want. If offshore names just didn't sell off, or if this just didn't happen, or if that just didn't happen. It's like, yes, if life wasn't life, then life would be different. It's not helpful. It's self-pity, and it's just the wrong framing as far as I'm concerned. So I'm happy. Don't really have much to say on any of this. If I did say I don't want to say if I had a wish for something or if I wish something was different, but I'm not going to play that game. So I'm happy with things. Kind of rambling here, kind of dragging on. So I'll end it here. Thank you for watching. Happy New Year's. Enjoy yourself. Be safe. Upwards and onwards. Stay in the course. 2024, here we come.